Hi, good day everyone, and welcome to our Tuesday class. Today we'll be continuing with the income statement part B, which is now we're currently at lesson number 18, which is chapter number 4 on your textbook. So you'll be aware that last week we're supposed to complete this unit, but we'll be a unit behind because of last week. So I'm going to try to merge the two units, lesson number 19 and lesson number 20 on Friday if possible. But if not possible, then we'll just be a week behind until we manage to cover everything up in one lesson. Because I don't want to rush you guys, but I want us to move together nicely because these coming topics are a very bit challenging and they are more finance, and I want you guys to be able to understand them in a much better way. So today we'll be covering page 200 to 206 of your textbook. The things that you need to learn or watch is the gross profit, how to calculate gross profit, net profit, what is the statement of profit and loss, the income statement. So we've already covered the explanation of the income statement on our lesson number 16, which was talking more about part 1 of the income statement, explaining each and every line item, how to even calculate our expenses as well as the gross profit, how to differentiate between which company is actually making profit. So we managed to cover that in our previous lesson. So from now going forward, it is important that you attend your classes, you complete each and every textbook activities that we are actually going to cover. So please just give me a second just to close some windows here in the office because there are some people outside who are actually making some noise. Okay, thank you very much for the confirmation. Okay, I'll be coming very shortly. Yes. Okay, so now here on this part, the learning outcome was still the same as of part A. So please just give me a second again. The door was left open. Okay guys, I'm not sure if it's happening on my side, but okay, the screen that I'm currently on, it's on the learning outcome. So where we talked about being able to define the income statement and explain each and every line item, differentiating between the gross profit, net profit, and cash on hand. So today's lesson will be covering the shrinkage and explaining ways to minimize shrinkage. And then lastly, we also talked about calculating the decrease and increase in sales and also finding the missing figure of the income statement. So those are the things that we'll also be covering. So we already introduced the income statement, and during the introduction, I did mention that the income statement is one of those statements that shows the company's income and expenditure. It is used to actually identify whether if the company strategy are actually paying off. At the beginning of each and every financial period, the company management sit down and actually develop a strategy to say, this is how we're going to operate this year and this is how much we expect to make as profit. So the income statement is a reflection of that decision on whether management decision have been good or bad. And another use of the income statement is also to use, you also get to use it together with your balance sheet statement and statement of cash flow to assess if the company is actually financially healthy, to be able to allows us to be able to go and borrow money or raise money. And investors actually use the income statement as one of those tools to actually assess if this company is worth investing into, because every investor wants a company that is profitable. So the income statement, I also did mention that it have got so many names. It gets to be named by the income statement, the profit and loss statement, the earnings statement, statement of financial income. So those are the names that it gets to be named by. But on our side, we prefer to call it the income statement or statement of profit and loss. Others also prefer to call this the statement of comprehensive income. So on my side, on my other device, it is actually showing that it haven't moved yet to screen of introduction. So please just confirm through the chat section if currently it's on the importance of income statements on your side. Because on one of my devices showing it's reflecting a bit late to show which slide I'm on. Currently I'm on importance of income statement. Can you see it? Can you just give me thumbs up if you can see it? I just want to make sure if it's not just my device, we are all in the same page. Please give me thumbs up. All right, it means that it's just only my device. Everything is actually moving according to the same pace. So here it's showing the importance of the income statement that we already covered on our previous lesson, to say that the income statement helps the business owner decide whether they can generate profit by increasing revenue or decreasing cost. So it allows us to study the financial performance of a company for a particular or for a one financial period. So the income statement does not reflect many years, it only reflects one financial period. Let's say to say that if your company operates from January to December, it will only show the income generated during January to December, as well as the expense incurred during January to December. So we also perform something called the common size income statement. So when we perform the common size income statement, it allows us to be able to see the difference between this year's cost and last year's cost against the revenue that was generated. So the common size, everything is placed in percentage. So here everything is placed in percentage. Our revenue is considered to be 100%, and then everything is placed against the revenue to see how much does each and every line item on the income statement contributed towards increasing revenue for this year or towards the revenue that we generated. So I'll also explain this during one of the activities that we are also going to perform. So the importance of the income statement also include few others, frequent reporting. So here it says that due to this, business owners and investors can be able to track the performance of the business closely and make informed decisions. So they are prepared. The income statement differs from the other financial statement because this one can be prepared on a daily basis up to even a yearly basis. So you can choose which range or frequency do you want to actually prepare it on a quarterly basis or a monthly basis. And then this report will therefore be allow you, or the income statement will allow you to see if your decision or your strategy is actually paying off. If it's not paying off, then you can be able to go back to the drawing board and revise your strategy so that it can therefore be able to reflect back on your income statement by showing an increase in profit. So it also pinpoint expenses. So normally we do budgets, and when we budget that this is how much we are going to make, this is how much we are going to spend. And there are some uncertain events actually occur that requires us to actually get up to pop up some money, and some event will actually cause us to actually generate more revenue because maybe a supplier warehouse actually got banned, or there was some drought over the other supplier side, and then people will not be able to go that side, they come to us to buy. So it allows us to be able to see any unexpected changes during what we actually plan during the year, the expenses that we never plan to incur, the one that we plan to incur, are we on track or not on track. So it allows us to be able to see all of those. And then the overall is to analyze the company financial performance to see if the company is doing well or not doing well. So on today's topic, we'll be talking more about shrinkage. So that one was just an introduction or a revision of everything we covered on our previous lesson. So on this one, we'll be talking more about shrinkage. And shrinkage in accounting, it's a term where it's used where there is inventory involved. So within our analysis of the income statement, we talked about one of the line item, which is the cost of sales. We talked about cost of sales. So cost of sales can only be generated when inventory is sold. And when inventory is not sold, cost of sales can also be generated, because once you have got inventory and that inventory does not get to be sold, and or you actually lose that inventory, then we consider that inventory to form, or we include it as cost of sales, because we actually sold that inventory. When we write it off, we'll include it on our cost of sales and say that our cost of sales have went up because we can no longer find that inventory. So here it says that shrinkage mostly happen when there is stock involved and can be for production or sales. So depending on the type of company you are actually running. So if we were to say that you're in a media company, or you are running an agency where you actually develop product, media product or packages, such as your banners, such as your billboards. So those kind of things require production, and therefore once you're doing that production, this also means that there will be some stock, or there will be some material that will actually be lost. So those material will actually form part of cost of sales once they are lost. So this means that company profit will be less because of this shrinkage. And then also, if you are running a retail or a wholesale where you actually buy and then go and sell straight to customer, you don't produce. So which means that when you buy your stock, and you hold that stock, and some of that stock gets spoiled or just get stolen, so which means that your stock gets to be reduced, but you actually incurred a cost associated with that stock. So which means that when that stock gets to be stolen or lost or no longer becomes sellable, so it means that you're going to include that cost within your cost of sales, because you can no longer do anything about that cost. You already incurred it, so it can form part of your cost of sales. So meaning that your cost of sales now is increasing, but your revenue is not increasing. So this becomes bad for a company, because now if cost of sales increase and sales does not increase, this means that our gross profit, our net profit will actually be very less because of shrinkage. So shrinkage, here it says that shrinkage causes the company gross profit to go down, because it's mostly affect the cost of sales. And types of shrinkage that we have got theft, breakage, aging, absolute inventory, natural disaster, fire and storm, and many other types of activities or event that can actually cause your inventory to actually get to shrink and actually make you lose profit. So in terms of shrinkage, shrinkage can also be mitigated by a number of ways. So I would like you guys to just think of any number of ways that you think you can actually mitigate shrinkage. Looking at type of shrinkage, we've got theft shrinkage, where an employee or customers actually steal your product, and then all of a sudden on your system, it shows you that you have got 100 units. And then, but when you actually go to the shop, or when you actually go to your warehouse, you only have 80 units. Meaning that some items were actually stolen. Breakage, some of them are fragile. You are having products that are fragile. Some customers drop them during during shopping. Some of them they get dropped during movement from warehouse to the shop. So those are kind of that's one type of shrinkage that you can actually have towards your inventory, and some of them will not be recorded immediately, and therefore your system will show a different thing. And then another type that we do have, it's called aging. Aging, it's when your product is actually no longer sellable. You have got a product that is actually very old, so meaning that now you have to scrap it, or you actually have to sell it or give it away. And then also I've got obsolete inventory. Obsolete inventory is those one that becomes outdated, and therefore you just no longer know how to actually deal with them. Either you give them away, or you just throw them away. And then natural disaster, it's when there is floods, fire that actually damages your inventory. So I want you on your side to think of any few ways in which we can actually mitigate this shrinkage and tell me on the chat section. So I'll give you guys 1 minute to just type each and every way or 3 ways in which we can actually mitigate this type of shrinkage. How can we avoid our inventory to actually shrink so that we remain profitable as a company? If you want to use a mic, you can raise your hand and then I'll allow you to unmute yourself and then you can answer the question. So the question is, what ways can we actually improve shrinkage? That is the question. So just tell me which ways. Please use the chat section if you... Okay, someone is saying insurance. So I would say insurance can actually replace shrinkage, because remember, insurance will only be able to cover you for all the loss that you only have through natural disaster, fire. In terms of theft, insurance will not give you anything back, actually in terms of inventory, because it requires a lot of investigation. And we've got Mamelo saying install CCTV cameras that will help in situation like theft. So that's another one way as well. So in terms of theft, then you can be able to see which customer actually stealing, and before they actually leave, you can actually apprehend them and tell them that what they're doing is wrong. So that can also reduce shrinkage in terms of theft. The CCTVs either in warehouse or in the shop. That's one thing that you can do. So someone say lesson office, okay, it's deleted. So we're looking for ways in which we can reduce shrinkage in terms of theft, breakage, aging, obsolete inventory, and natural disaster. Someone say FIFO to mitigate aging. So we use the first in, first out method, meaning that the product that came in first will actually have to be the one that goes out first, and then the one that came in last will be the last to actually goes out. So that actually allows us to eliminate aging. So that's one of the good things. This was from Rato. So okay, so most of your answers are correct except the one of insurance. So these are the ways to actually minimize shrinkage. So you tighten your security inside your shop or warehouse, meaning that you will install CCTV surveillance, such as a closed circuit TV, so that you can be able to monitor movement of your customers. You keep accurate records of all your inventory movement. So like I did mention earlier, to say that in terms of breakage, something break during movement and we do not get to receive feedback on the same time, and therefore some employees do not report such and some customer do not report such. So meaning that you need to always do stock count all the time, so that you're able to assess your movement of inventory, how much inventory was taken from here to the warehouse or to your shop, and then how much actually break or how much was received, how many of your inventory is still in the shop. So those kind of information. Provide adequate and secure storage facility, which will actually, which means that if your storage is secure enough, you need to make sure that it's not easy for natural disaster to actually then damage your inventory. So this means that your property needs to be well developed and well safe in terms of fire hazard and all those stuff. Ensure that correct product and quantities are shipped to customers. This also is one of the most important things. Sometimes when we're selling our product, we sell our product and then we give a customer an incorrect product. Those who buy online, and then you receive an incorrect product. So on my side, as a business, we actually get to lose profit. We find that you give the customer a product that is more pricey than the one that the customer bought. So this means that you actually lost in terms of profitability, and therefore this means that your profit margin will actually now be low. So to add on top of this is to keep or buy minimum inventory. So it is important that when you buy inventory, do not buy too much, just buy enough inventory. So I won't say minimum, I'll just say buy enough to avoid your product becoming obsolete. So that meaning that when the product become obsolete, you'll still be able to do what? You will not be having too much inventory so that you don't have to throw away too much of your inventory. So this means that only little inventory will be thrown away. So here it says that there are numbers of ways to reduce shoplifting incident, such as installing CCTV cameras, placing easy to steal item behind cages, neat shelf packaging, and many more others, that also including buying just enough inventory and actually stitching, putting those, what do you call those things, things that the scanners at the door, so that those who actually steal can actually be found when they leave without paying. So the tag scanner at the gate. I forgot what they actually call those things, but I know that they use something called the RFID scanner codes, kind of the stuff. So you're able to track the product movement all over the shop, as well as if it leaves without it being sold, because the tag is still there. So those are the ways you can use to actually reduce shrinkage. And then someone mentioned about FIFO during the ways of mitigating shrinkage, which is also one of the best method to use if you're actually going to be buying things in bulk. So when we talk about FIFO, this brings us now to some of the types of inventory system that can actually be used to avoid shrinkage. So we've got two method or two system that gets to be adopted by companies. We've got perpetual system and periodic system. So perpetual system is the one of those systems that allows the company or requires the company to calculate inventory every time every unit is sold. So meaning that whenever you sold a unit on perpetual, you recalculate your cost of sales, and you also calculate how much units are actually left within the company in total, including the one in the warehouse. So normally here we use a system, or we use an online system or an accounting software. And then on periodic system, the name explains everything itself. So under periodic system, the company calculates inventory at the end of the period, not during or at the beginning. So we wait for the end of the period for end of the month or end of the year, and then we do our stock count to see how many units we actually sold, how many actually units did we actually bought. So which means that we're actually remaining with 20 units. So that's periodic system. So periodic system is one of those systems that actually allows shrinkage, because this one you're not able to track much of your inventory. So you only manage to see the difference of your inventory once you start preparing at the end of the period. So here it says that periodic inventory uses an occasional physical count to measure the level of inventory and the cost of goods sold. So meaning that at the end of each and every month or 3 months, when you go to the shops and they tell you that we will be closed at 1 o'clock because we're doing stock count, it's because they use a system called a periodic system. So it doesn't actually keep up with them or tell them how much of inventory or stock is actually remaining. So their system does not able to track how much of things are on the unit, how much of things are in the stock room. So therefore, they are using periodic system. And the perpetual system, it keeps track of inventory balance continuously, with updates made automatically whenever a product is received or sold. This is when we are using our accounting systems that are well built up. So it means that when we capture our inventory, we capture inventory once we receive it, it will show that how much is in the warehouse, how much is in the shop, how much was actually sold, how much is remaining. If something gets to be stolen and we get to update the system, it will also automatically update that this is what's happening. So this one does not get to require much of stock count. It's just only a confirmation of stock that is on the shelf to see if it matches whatever the system is actually saying. If we're talking about warehouse, it's also a confirmation of the number of stock that is there. So the stock count is not the same as the one that we do here under periodic. So in periodic, we'll be updating the number of units sold. We'll also be updating the number of item remaining as well. So he'd continue to say that periodic inventory accounting system are better used to small businesses that have easy to manage inventory and those with low sales volume, because they know at the end of the period this inventory is not too much and they can be able to track and see that we are running out or we still have got some inventory or we need to buy. So this is when we get to use periodic things such as your smaller retail shops, your spazas, they get to use periodic because they sell until they just notice that something is off. But for bigger companies with large high sales volume and multiple retail outlets, they need a perpetual inventory system because they need to keep update and track how often do they actually sell this and which product are they selling. And therefore, once every product gets to be sold, they need to update the system, because imagine doing a stock take at places such as your Pick n Pay or Boxers. You can see your Pick n Pay, your Pick n Pay Hyper, your Micro, your Game store. So those are big retailers. So for them to do a stock count, it can even take months while they actually close and losing revenue. So to avoid that, they need to adopt to a perpetual inventory system that allows to tell them that on the shelf, we're left with 4 items. And when you go to the shelf, you expect to see 4 items. If there are less than those items, then that's when you get to do the investigation. On periodic, it won't tell you anything about the system that you have got 4 or 5. You just know that you bought 40 and then you just continue selling until you find that there is nothing. You told the customer on hand or the same moment that is there that say we don't have stock. You just say I'm going to check, then you come back and say we don't have stock. So that's periodic. But on perpetual, you tell the customer the moment that they're standing with you to say that the system tell me that we do not have this, and you can avoid that so that you plan ahead and buy the product earlier. So that's the good thing about the perpetual inventory system. So here it says that cost of goods sold is an important accounting metric, which when subtracted from revenue, it shows the company gross margin, which is the gross profit margin. So with these two, perpetual and periodic, we've got two methods. We've got FIFO and we've got weighted average method, and some others, they also have got something called LIFO. So it doesn't matter which one you choose. Some people will say that under periodic, most of the time a weighted average method is used because you calculate average of all your costs inclusive of the new and the old, and then you sold. But under perpetual, because you keep update of your inventory and track, that's when most people get to adopt the FIFO. The first stock that comes in is the first stock that comes out. Some will actually adopt what we call the LIFO, last in, first out. Give the customer the best quality product or the fresh product that is actually now available and fresh. So that will be the first one. So that means last in, first out. So those are the three kind of methods. So these will refer them as methods of managing inventory, and therefore these are the system that gets to be used together with the method to adopt inventory. So before I move forward, in terms of calculating the cost of goods sold under the perpetual and periodic, is there anyone who have got any questions so far? Anyone with a question so far? Anyone with a question? Okay, thank you very much for the thumbs up. So this now brings us to calculating our inventory. So we're calculating our cost of goods sold, calculating our cost of goods sold under periodic and perpetual inventory system. So the cost of sales under the periodic inventory system is calculated as follows. So this is mostly for manufacturing, for those who are manufacturing. And then there are those who are in retail. So here we'll be focusing on the retail, sorry, not manufacturing, it's retail. I just thought it was going to be manufacturing. So it's going to be retail, the same as a media company that buys product and sell product without actually modifying them or just modifying them here and there. So we'll be taking a look at a retail. So when you calculate your inventory, you are going to have opening inventory. This is the inventory that was remaining from the previous month. So here it is positive. This one is always positive. And then after that, during the month, you are going to add, or at the beginning of the month, you are going to purchase inventory. So this is also positive. It will be added together with the opening inventory. This inventory, when you purchase it, you're going to incur transportation cost. So you add it, so it's positive. You're going to incur import tariff if you're importing from other countries. So this is another positive amount. And then custom duties, you're also going to incur custom duties at your borders. So you add it together. So this means that your total purchase cost of your inventory, it will be inclusive of your purchase price, your normal inventory price, plus transportation cost, plus import tariff, plus custom duties. All of this will give you what you call the total inventory cost for the ones that you just bought. And then you're going to add it or combine it with your normal opening inventory. This will give you what you call here, you'll then have a total. This total is called inventory available for sale. So once you add your opening inventory plus your purchase inventory, including all the cost associated with the one that you purchased, this will give you the total cost that is called inventory available for sales. So once you sold all your inventory, you will be remaining with closing inventory. So closing inventory, this will be the inventory that is remaining after you have sold your inventory. So therefore, this means that if you go and say your opening plus the one that you purchased minus the one that is remaining, this will therefore give you your cost of goods sold. So in another way, we can also calculate and go and say your opening inventory plus your purchased inventory minus sold inventory. This will be equals to closing. So if you are using periodic, this will be the method. If you're using perpetual, this will be the method, because your opening inventory plus purchase, every time you sold something, it's going to calculate the closing. Every time you sold something, it's going to calculate the closing. But under your periodic, you first calculate how much did we actually have as an inventory at the beginning, how much did we add, and then how much is actually remaining, and then this will actually give you how many you actually sold. So this is what we will call this is what we actually called your periodic inventory system. So your periodic inventory system requires you to identify first your opening and then your purchases during the period minus your closing, the one that you have now on hand when you're doing a stock count. Therefore, this means that the difference between the two will actually be your cost of goods sold. So here it says that under perpetual inventory system, the cost is calculated the same way, but for each transaction. So the perpetual system keeps track of inventory balance continuously. So this means that cost of goods sold is calculated every time, every day you actually sold something. So this is done through what we call a point of sales computerized system, such as your QuickBooks, Sage 300, Xero, as well as other accounting software that you will adopt for your business. So they allow you to be able to track your inventory from warehouse, your Cypro system. They allow you to be able to track all your information from warehouse to the store every time something is sold. Therefore, you'll be able to generate, it will generate your cost of sales. It will also generate your it will also generate your closing inventory as well as the inventory available. So this can only be done through a perpetual inventory system. So in terms of assessment purpose, just note that this one will not be tested in terms of your assessment. I'm teaching you this for learning purpose because this is more deep in terms of accounting. It goes even further where we include your FIFO, your weighted average method in adoption of which type of system you're going to adopt. So it's a very long topic or content that it will take time for us to actually understand, especially with the background that you are not from accounting and you do not understand much in terms of the financial mathematics. You don't have financial mathematics background or pure maths background. So this is where you get to play around with maths a lot when you talk about the FIFO, the first in, first out. So in example, I will say, let me just give you an example of how it works if we're applying FIFO. We'll say that we are actually using any of these. So assume that you bought 20 banners at 100 Rand each. This was 1 April. On the 15th of April, you bought 30 banners at 80 Rand. On the 20th of April, you sold, so this is sold. You sold 25 banners at 150. So the question will be, what will be your cost of goods sold? If we were to use perpetual, so the cost of goods sold within this system will be mostly under perpetual, is that when we're applying the FIFO method, it means that we are going to start by selling the 20 units we bought first, then followed by this. So this means that the cost of sales, so I'm just gonna write here, the cost of sales will include 20 units that was bought at 100 Rand, as well as 5 units that was bought at 80 Rand. So you're gonna go and say 20 multiplied by 20 multiplied by 100, 2,000. 80 multiplied by 5, that will be your 400. So this means that under FIFO, your cost of sales will actually be what? 2,400 under perpetual inventory. But then if you are using that other method that I did mention, which is called the weighted average method. So if we were to use the weighted average method, what happens is that whenever we buy inventory, we first calculate the average price or the average cost that was incurred to say that the total inventory we had before we sell was 50 banners. And then with this all 50 banners, each was bought, we had 20. That was bought at 100. We have got 30. That was bought at 80 Rand. So here is going to be 100 multiplied by 20. So here you have got 2,000. Here you have got 2,400. So the total cost of buying this or the stock that you have during this period was 4,400 and the total inventory was 50. So this means that if we were to use weighted average method, this means that we're first going to calculate the average cost of having 50 stock on hand, which is going to be 4,400 divide by 50. So this means that each stock on an average basis costs that 88 Rand. So meaning that when you calculate your cost of sales, we will no longer be using or following the FIFO method because we're using weighted average. It was actually going to say we sold 25. The cost of sale is based on the average cost, which is 88 Rand. So therefore, you're going to have 25 units that were sold multiplied by 88. This gives you 2,200. So you will notice that this have got a difference compared to FIFO. The FIFO cost of sales says that it was 2,400. This one will tell you that your cost of sales at an average it's 2,200. So meaning that on FIFO you get to report a lesser profit, and then on weighted average you get to report a higher profit. But in reality, the weighted average cost will actually therefore also mislead, because that is not the exact cost that you actually incurred when buying the product. So the weighted average only applies mostly when there is not going to be much different in terms of buying a product from a supplier. Supplier will always give you your product at a fair price that is not far from what you actually buy from. So that means that you can be able to apply the weighted average method. But if that's not the case, you're going to be using different supplier. So a FIFO method will actually be best, and therefore your price will actually need to be adjusted to accommodate that you buy product at different prices. This means that your price should be noted that it should be inclusive of these changes, that when you sell a product, each product will have its own different cost, and therefore the selling price needs to accommodate the difference in prices that you actually incur. So that is everything that happens within the perpetual and periodic system if we include the FIFO and weighted average method. So is there anyone who've got any question so far? Anyone with a question so far? Okay, if you don't have any question, then this takes us to the difference between perpetual and periodic system. What are the key difference? So the first thing is the recording method, where perpetual uses a computer and a software that automatically update company's ledger account. If you still remember the ledger account, the T account, the debit side, the credit side, whether the account is increasing or decreasing. So that's the ledger account with information about the product as sold and the remaining inventory. Periodic system, though, actually requires us to do everything manually. We calculate our cost of sales manually, and we also get to identify our information, our remaining stock on a manually basis. And then in terms of margin of error, there is a lot of error that can arise through the periodic system, because everything have to be done manually, and if you miss something manually, therefore you will not be able to see it. But once everything is done automatically through computerized, then you'll be able to notice that the sheet is saying 20 here, that we have got 19, so which means that there is a miscount of an item. So you go and actually recheck that. So just a quick moment. Okay, sorry about that, guys. So this then brings us to the efforts. So in terms of efforts, the key difference is that the company aren't required to put in too much effort in the perpetual because there is a system and an infrastructure that they get to follow and use. In terms of periodic, physical stock counts actually get to be taken, and they are actually tiring and demanding for employees. So meaning that if some mistake has to happen, therefore recounts needs to be done. And then in terms of cost of sales, which is also known as cost of goods sold, so this means that there are no continual entries under the cost of sales associated with periodic inventory system as there are with perpetual system, because on perpetual we calculate everything on a daily, so meaning that we don't have to do much adjustment. But under the periodic, we will therefore also need to adjust our cost of sales, or we get to be calculated it based on whatever findings we do there on the system. So meaning that you might find that we even have stock that we're not even aware of. So this means that when you calculate our inventory cost, it might actually be a bit higher or lesser depending. So we don't even know how much we actually get to sold under the periodic inventory system. So shrinkage and inventory counts, so this goes together. So the inventory counts, it's there to actually assist us to actually reduce the shrinkage cost. So here it says that under the perpetual inventory system, the trade inventory account should at all times reflect the value and quantity of stock at hand. However, it might happen that times some of the inventory becomes stale, damaged, or stolen, and therefore you might find that when you go on the shelf, that stock is not there because it was actually stolen. So therefore, the shrinkage part comes in to actually assist those way that we talked about, the ways in which to mitigate shrinkage, the ones that talks about, so that when we go and do our stock check or stock count under perpetual, we're just confirming if the stock is still the same. If the stock is not there, we assume that it is stolen or damaged, or if it's missing, it's either stolen, misplaced. So one of those things, we will check the shop just to see if it is misplaced or not. So meaning that we don't get to worry about the rest of the stuff. We're just only there to confirm if everything is the same. But under the physical inventory count, it will reveal any discrepancy between the value of inventory on hand and the estimated value according to the system, which is the trade inventory account. So this is why perpetual is one of the easiest and best method to adopt if you're going to run a business, or even it's a media business and you want to track your inventory system. So make sure that you adopt to the perpetual system. It says that the value indicate best case scenario where there is no shrinkage in inventory account. So if the inventory account reveal discrepancy, such deficit will be counted as a loss. This discrepancy will therefore increase the what, or debited in the cost of sales account. So here it says that, see example 4E, page 204, if you want to understand more about how the shrinkage and cost and inventory count affects the company cost of sales, and why do we credit to it cost of sales, as I've explained at an earlier stage. So this brings us now to our class activity. But before we start with the class activity, do you guys have got any question that you might have? If you have got questions, please ask those questions now. Do you guys have any question? I'll be on the chat section. If you have a question, you can ask it on the chat section. Okay, if you do not have any question, let's go to activity 4. So this is what is activity 4? So this is activity 4F that I just want us to take a look into. I'll try to zoom in a bit. So I just want us to start with number I, which says study the extract from the statement of profit or loss and other comprehensive income of Francis Traders for the 2001 and 2020.2 financial year and answer the question below. You have got sales for 2.1, which is 600,000, 2.2, 720, gross profit 200,000 and 280 for 2.2, expenses 185 and 206 for 202 respectively. Net profit 15,000 for 2.1 and 74,000 for 2.2. The question says, by how much did sale increase in 2.2 and calculate the gross profit margin for 2.1. Calculate the expense as a percentage of sales for 2.2 financial year. So on this one, I want you to calculate. Okay, this doesn't allow me to write on top. So here on this part of 2.2, I want you guys to actually also do the one for 2.1 so that you can tell me whether if the expense we incurred this year were more than the expense we incurred in 2.1. So this will be able to allow us to be able to spot the difference. So this is one of the method. Number C, it's one of the method that I was explaining about in terms of the common size income statement. So everything is expressed as a percentage of sales to assess if this year we spent more compared to last year when measuring against the revenue or the sales. And then number D, calculate the cost of sales for 2.1 and 2.2. So what I want you guys to do is please attempt all of these A, B, and C, and D in the meantime and send me your answers on the chat sections. So I'll give you guys the next coming 10 minutes to actually write all of those and then send them on the chat section. You can just type them on the subsection one by one. How much did sale increase by for 2.2? Just write A and then just write B, C, and D, and then we'll be able to discuss the final or the result afterwards. So 10 minutes. Start now. So we are now sitting at 13:58. So by 10 past 2, you should have done with your calculation. You should give me answers. Once you are done, also start with, Once you are done, also start with Roman figure number 2. What effects will shrinkage have on the profit of the business? And then we'll talk about the rest at a later stage while we continue with the activity. So this is our last activity for today's lesson, or this is the activity for today's lesson. And then once we're done with this activity, we'll be done with the lesson. So please attempt Roman figure number 1 for now, and then we'll work around it. I'll explain everything once you show me your attempts. So it's now 2 o'clock, so the time starts now. So your time starts now. On your textbook, this is page 205. I just wanted to find the page on your textbook. Page 205, yes. Okay, guys, I'm still waiting for answers. So far, there are no answers. Okay, we are 5 minutes in. So I hope you have already started. I already received one answer. So what I want you to also do is that on number A, if you can, I want you to also identify those A and B as a percentage. How much did sale increase in 2022? So it should be in percentage. Calculate the gross profit margin for 2.1. So the gross profit is already given. So what you have to do is to calculate it in percentage. So everything here, most of it is being calculated as a percentage, except for number D, which says calculate the cost of sales for 2.1 and 2.2 respectively. Sorry. So this one you'll actually be calculating them in terms of rents value. The other three will actually be in percentage format. So calculate me how much the 120 is in terms of percentage format. For all those who wrote 120 on number A, it is correct, but please right now try to calculate it in percentage format. How much is that in percentage format? How much is the increase in percentage format? Okay, in terms of number A, all those are saying 20%. You are 100% correct. So I'm going to switch back to the PowerPoint presentation. I'll switch back and forth. So please bear with me because I'll be switching back and forth. So number A, it's 720,000 minus 600,000. All of this will be divided by the previous year. So this will therefore give us 20%. So the increase on number A is 20%. For those who are calculating number A, so our sales increased by 20%. In rents value, it increased by 120,000. So for those who say 120,000, it's correct. For those that are say 20%, it's correct in terms of percentage. So in terms of number B, it says that calculate the gross profit margin. So gross profit margin, so most of you guys get confused by the terminology since we are now working towards financial statement analysis. So I will explain the two differences. If the question says calculate the gross profit, that means that you are calculating it in rands value. So once we talk about these two questions requires two different answers. So the first one, calculate the gross profit. So this means that your answer needs to be in rand format. Calculate the gross profit margin. This answer needs to be in percentage format. The moment you include the word margin, everything then goes to a percentage. So meaning that on this point, make sure that whenever you ask to calculate the gross profit margin, you're calculating a percentage ratio. Whenever you're calculating a gross profit, you're calculating a rands value. So on number B, so I'm going to switch back. Number B, calculate the gross profit margin for 2.1, which is 200 and 600. So meaning that here we're going to have 200,000 out of 600. So gross profit, it's your gross profit margin, it's your gross profit over sales. Therefore, this will give us your final answer to be equals to 33.3%. So let's see how many of you managed to get this one right. So we've got Rato got it right, and we've got Manda got it right, and we've got Mamelo did a correction, and then she managed to get it right after the correction. So that's your gross profit. And then the last one, or number C, not the last one, second last.
Hi.
Yes.
So I said 200,000 divided by 600,000 times 100, but still got the same answer.
33.
Yes.
Yes, 33.3% is the correct answer on number B. Any question on that? Okay, let's now move to number C. Number C says calculate the expense as a percentage of sales. So expense is 105 for 2.1. So I'll just write 2.1 over here. So it's 105. All of these over 600,000. Then for 2.2, we'll actually be having 206. So not 206, yes, 206 over 720. So here you're going to have 30,000 and 30.83%, and then on the other one, you're going to have 28.61%. So these are all expenses. So let me just quickly answer the door. There is someone busy knocking at the door. I'll come back very shortly. Just a moment. Sorry about that, guys. Today I'm doing the online in the office, so it's a very bit disturbing due to the knockings. So here we're going to then have, these are what we call our expense expressed as a percentage of sales. So meaning that here during the year 2.1, for us to generate a revenue of 600,000, the expense contributed 30.83% of these total sales. And then in 2002, for us to generate the revenue of 720, expense contributed 28.61%. So this is the explanation behind, or this is why we get to calculate that we are assessing how much did our expense contribute towards the revenue generation. You will notice that in 2.2, our expenses were actually less in terms of revenue generated. We managed to reduce our expenses even though we generate a higher revenue margin. So this means that in 2.2, we expect to have a higher net profit margin compared to 2.1 because the expenses contributed more. And we actually spent more money in terms of generating revenue. And comparing the two prices of revenue, we have got 600,000, 720. But if you take a look at 2.2, our contribution is actually less compared to contribution by expense by 2001. This means that 2001, more expense were incurred compared to 2002. So we only get to see this through the percentage expressed through expenses expressed as a percentage of sales. If we look at the expense themselves, you will think that in 2002 you spent more, but in reality in 2001 that's when you spent more, and then you generate less revenue. But in 2002 you spent less compared to 2001 in terms of percentage expressed in terms of revenue, which means that you expended less and then you generate more revenue. So meaning that in 2.2 we expect you to be more profitable compared to 2.1. So any question on this part? I'll just like to see how many of you managed to get this right as well. So number C, 28.61, 30.38, Manuel got it right, and Rato got it right. Mamelo got it right, but unfortunately didn't do Mamelo and Rato did not manage to actually do the one for 2.1, even though it was not required, but I asked you guys to do it. So this is what it actually explains. So that common size income statement that I mentioned earlier on, to say that we use it as part of comparison to see if this year financial performance is better than last year performance, because the income statement is the measure of financial performance. We measure how we performed on a yearly basis based on the income statement. So when we perform a common size income statement, we calculate everything based as a percentage of revenue. And then this is the type of information we're going to see in terms of 2002. So meaning that I'll just write this side: sales, cost of sales, gross profit, other income, and then operating profit, operating expenses, and then here you have got profit before interest and tax. So normally if we do a common size, this is how things will look like. So here it will say 100%. Here it will say 100%. These are all the revenue that we generated during this period. So they will be all in 100%. So in terms of gross profit, cost of sales. So cost of sales, assuming that here it's gonna be something like, let's say 45%, 55%. And then here the gross profit will actually therefore be 65%. Here will actually be 45%. Sorry, 55 over here and then 45. So what this means is to say that during the year 2001, cost of sales contributed 45% for us to generate a revenue of 100%. And then during 2002, cost of sales contributed 55%. So the more the higher the percentage, it means that the more incurred expenses we incurred compared to the revenue we generated. So this means that lesser what? Profit margin. Same applies to these operating expenses. So here on operating expenses, we've got 30.83 and 28.61. So this means that when we calculate our profit before interest and tax, here we expect it to be low, here we expect it to be high, because here we spend it more in terms of expense, here we spend it less in terms of expense. So this means that for us to generate this 100% revenue, 28% of it is being generated by operating expenses, which accounts for this, which means that if we're to subtract this from this 45%, the gross profit or net profit before interest and tax will actually be 45 minus 28.6 if there is no other incomes. So this is the explanation of the common size income statement. So here we are actually calculating it without, the book did not explain what we are actually calculating. So myself, I'm actually explaining to you that we are calculating the common size income statement, assessing which one we spended more and which year we spended less, looking in terms of contribution by expenses or looking in terms of contribution by cost of sales. So the last one, number D. Number D says calculate the cost of sales for 2.1. So your cost of sales will be your sales minus gross profit, giving you 400,000. And then for 2.2 will be 720,000 minus 280,000. This one will be giving you 440,000. So all of those who calculated it, they managed to get it right. So this then brings us to what effects will shrinkage have on the profit of the business? So that is the next question. So I want you guys to just answer this on the chat section. I believe I've already given you the answer on this one. So what effects will shrinkage have on the profit of the business? So this one I'll just answer since we already just talked about it not so long ago. So it will actually have a negative impact on the profit of the business, because shrinkage causes cost of sales to increase. When cost of sales increase and sales is not increasing. Therefore, net profit will actually, or our profit actually going to be very low. So this means that we then get to suffer a negative impact by shrinkage on profit. So that is the answer to Roman figure number 2. Going to Roman figure number 3. So Roman figure number 3 says that use the information below to answer the question that follows. I just wanted to quickly confirm if I'm not muted, because it do happen sometimes that I speak and I'm actually muted, and you guys do not actually get to notice as well or notify me. So extract from the ledger account totals from books of Loveday project. You have got services rendered of 150, rent income of 30,000, profit on disposal of non-current assets. So meaning that we sold one of our long-term assets and therefore generate a profit of 5,000. Interest received 5,000. Telephone 15,500. Water and electricity 13,200. Wages and salary 25,000. Insurance 2,500. Advertising 6,000. Number A, calculate the gross income for the year, and then number B, calculate the net profit for the year. So this is the company that is in a business of rendering service. The company that is in the business of rendering service. So you have got services rendered of 150, rent income of 30,000. So in terms of calculating the gross income for the year, gross income for this one will actually be 150,000. So I'll just explain it to you guys why, because I know this one is going to be complicated. This company did not, or this information did not give you anything in terms of services rendered cost. So if you do not have services rendered cost, this means that you will not be able to go and say services rendered minus services rendered cost and then get your gross profit or gross income. So this is what makes this a bit challenging. And then you can be able to calculate the net profit by going and say all the income you received minus all the expenses you incurred. So the first 4 are actually your income, and then services rendered, rent income, profit on disposal of non-current assets, interest received, they're all income. You add all of them together, you minus all your expenses, which is telephone, water and electricity, wages and salary, insurance and advertising. This will give you the net profit for the year. So on the first one, this information is a bit, there's some information missing, meaning that you just put a 0 on the information missing. If you remember during class, I mentioned that a company can either be in a business of rendering service or in a business of selling product. So if it's in a business of selling product, you are going to have sales and cost of sales. If it's in a business of rendering service, you're going to have services rendered income and services rendered cost. Here we do not have services rendered cost. So this means that we are not having any cost in terms of servicing or doing our project. So we're just charging for the service that we offer. So there is no cost associated with it. So this means that our gross income will just be 150 minus 0. This gives us a gross income of 150. So if your book says on awards, that information is incorrect because there is no services rendered cost. So in terms of gross income that you earned, you have got your services rendered, rent income, profit disposal, and interest. So gross profit, so I'm talking about gross profit, not gross income, gross profit. So in terms of gross income, just add all your income that you have earned. This will totally give you a gross income. Net profit, subtract all your expenses, then it will give you your net profit. But gross profit, you can't calculate it without services rendered cost. And then lastly, name tools inventory system that a business can make use of. We talked about periodic and we also talked about the perpetual. So those are the 2 types of inventory system that you can work around. So do you guys have got any question? Because I think that was the last part in terms of activity number 4 for F. Any questions that you do have? Please ask me any question you do have in terms of for F or whatever we just covered so far. If you have got any question, feel free to ask that question right now relating to our lesson. Anyone? So are you all happy with the lesson? Just give me a thumbs up if you are happy with the lesson. So as part of the lesson, you are required to do this as a homework, activity 4G. Please write it down that you are required to perform activity 4G as your homework. So activity 4G, it's your homework. This is what you guys need to cover. So in the remaining 30 minutes period, I'll expect that you guys try to attempt to do activity 4G. And then when we meet on our next class, you actually get to, I'll get to start by looking at this. So our next lesson, it's going to be, just a moment. So activity 4G, it's your homework. Our next lesson is interpreting financial analysis and interpretation of financial statements. So I do not want to merge this together with what we just did. This is required to be an independent introduction lesson because we'll be covering introduction to financial analysis of financial statement. And it requires that your mind is fresh and so that you don't, when I explain everything, you will not get to lose focus, because right now I believe I've already given you guys enough information that you need to work around. So on Friday we will start with this one, and then I believe we'll also do lesson number 20 because it's part B of this. And I'll try by all means to find best way to explain this, because this is one of the most important topic for your own personal use as well as for learning purpose in terms of you being in a work environment, analyzing financial statement and interpreting them. So we're going to be performing ratios, which gets to explain how the company is actually performing. So all of that will be within these two lessons, part A and part B, which is lesson 19 and lesson 20. So if you do not have any question, or I will allow you guys to have the next extra 2 minutes or 3 to ask any question if you do have any question. Any question, guys, on the lesson that we just had? Okay, in absence of questions, this brings us to the end of our lesson. Please make sure that you go and do activity 4G. This is your homework. This is the first thing that we're going to start with on Friday, just to make sure that you guys did manage to do it, and I'll do a follow-up on this by asking you guys to share your final figures on activity 4G. Please attempt it on your own before you take a look in terms of the solution, and then I'll explain the solution during the lesson, and then we can start with lesson number 19 on Friday. So in absence of questions, this is where we're going to stop our lesson for today. You will enjoy the rest of your week, and I hope I will be better by Friday and things will be very, very much better. So let's meet on Friday. Yes, meeting guests, you can ask your question. We've got guest. Yes, I see your hand is up. The guest, it says meeting guest. Please unmute yourself and you can ask your question. Is it an error? The meeting guest, I see your hand is up. So let me just quickly, I'll stop the recording. I just want to quickly clear my nose, so I'll just mute. Maybe the meeting guest is still